Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research Incorporated, a broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and SmartPro Financial are not affiliated. Welcome to SmartPro Radio. This episode is hosted by Rick Godfrey II, CEO and co-founder of SmartPro, and David Romhilt, who's a founding partner and chief investment officer of Summit Trail Advisors. As chief investment officer, David's industry-recognized work on asset allocation and manager selection guides Summit Trail's centralized advice team. Prior to founding Summit Trail, David was a managing director at Barclays Wealth. There, he was global head of alternatives, head of manager due diligence, and the chief investment officer of Barclays Wealth Trustees, NA. His responsibilities included separate account, mutual fund, hedge fund, and private equity manager due diligence. He served a similar role for Lehman Brothers and Lehman Brothers Trust Company, NA, prior to Barclays' acquisition of Lehman Brothers in September of 2008. He began his career at Cambridge Associates LLC, focusing on performance reporting and manager selection for many well-known foundations and endowments. David is a CFA charter holder and a member of the New York Society of Security Analysts. He has a Bachelor of Arts in Economics and History from Wake Forest University. Let's get started.
All right, thank you for joining us. We got David Romhilt on the show. We're so excited to have you because you bring a level of expertise that I'm not quite sure we've ever had our audience be able to tap into. And hopefully they spent the time listening closely to your bio on the intro of this podcast because it's rather impressive. I mean, it's like a who's who, and it's really unique in our industry to have such expertise that we can talk to for our clients. And Summit Trail Advisors, you're a founding partner of that firm. You are their chief investment officer, and you really focus on ultra high net worth families and serving them well. And that firm has started relatively recently. I mean, in less than a decade, you and your team have grown it to over 20 billion in assets, which is really impressive. And the connective tissue between you and our audience is that we reach out and talk to you guys with some guidance and ideas on our investment models for our clients. And so you're getting just amazing expert advice, but also coming into our world, which is not the ultra high net worth, but more middle America. And they're getting that top end level advice from an expert like yourself. So thank you so much for joining us and spending some time to kind of go over some common questions that people may have when it comes to their investments in the investment world.
Great, Rick. Thanks for having me. Excited to be here.
So I want to jump right in. And the first one is, because we hear this all the time, you go online right now, you go onto YouTube, you can find anything you want about investments. And the information is plentiful, and it probably isn't the best for a lot of people. But a question we get, and maybe you've heard this as well, is why do I care about any of this investment stuff? Why don't I just put all my money in the S&P 500? What do you say to that?
So there's a couple aspects of that. I think the short answer is the experience investors have had over the last decade is that the S&P has been incredible. And you could argue that if the S&P is going to compound at 13 to 15%, which is what it's done each year over the last decade, that's probably not a bad idea. You could argue that that's actually the right thing to do. I think you have to unpack it a little bit and really think about whether that's likely to continue. And so one example I kind of think about in explaining it is, if we go back the last 5 years, so right before COVID, and we look at that and we say, okay, the S&P has doubled. It's gone up more than 100%, which is great. Over that same time period, the earnings of the S&P have only gone up 50%. So 50% of that performance has come from those companies are fundamentally earning more, which makes sense. The other 50% has just come from people who are willing to pay more for it. So I think the likelihood of that continuing is not high. And that would then question whether it's going to continue to be that leader and that outperformer. Are you going to continue to be able to count on 15% every year from the S&P? If you could, that's going to solve a lot of financial problems for a lot of us.
Sure.
And we probably don't need to worry much about retirement. But the reality is that's not what it's on very long term. And usually after a period where it's done so well, like if we take the 1990s, it compounded at 18% for that whole decade. The next decade, which was the 2000s, it was negative for that entire decade. So I think reality is that this can't continue the way it is, and that will force people to have to find other ways to invest without just saying, okay, the S&P is going to eat everything, compounding that much.
What does it tell you if people are willing to overpay that much?
Yeah, I think it's interesting. I mean, I think it's a couple things. One, I would say the environment that we've been in, the cost of capital has been very low, for most of it. Meaning, interest rates have been close to zero until really the last 2 or 3 years. And so that creates speculation. That creates people being interested in trying to earn very high returns because you can't earn any returns by keeping the money in a bank. Mm-hmm. So I think that's part of it. I think also if you're going to pay a high return for something, you have high expectations.
That's right.
I'm willing to pay a really high price for something if I think it's going to be really good. If I went to a really nice restaurant and the food was bad and it was really expensive, I wouldn't go there again. Mm-hmm. So if I buy NVIDIA or Google or one of these names and it continues to deliver, 15 and 20% growth, then I'm going to be rewarded for paying up. But if those companies ever falter, this is the problem with a high price stock. If there's any sort of faltering, any sort of question about whether that growth is going to continue, you're not just going to get a sell-off because of that. You're going to correct that overpayment. And that's where you'll see these drawdowns, whether it's a stock or something like the S&P 500, that's much more painful than, a 5 or 10% reduction, because investor hype and expectations have to get reset in addition to the company fundamentals not being as good.
What do you say to somebody that may make the argument there's so much momentum, there's so much money going into these because people are just used to it? Automatic investment, that's what they're doing. There's all this change from maybe active management into this more passive, style that it's almost inevitable.
I think there's been a structural change. I mean, I started my career in 1998, and that was actually a period where a lot of these same conversations were going on. The late 90s, there was these incredible dot-com era, and Cisco and Intel and all these names were coming and were huge parts of the index. And so it was a really similar conversation at that time. The difference was we didn't have ETFs. We didn't have retail investors who could open an app and buy the S&P 500 on their phone. And so that momentum stopped because those companies didn't deliver. And what followed was a decade of very disappointing performance, but actually active managers did very well because they weren't invested in, the S&P 500 names. I do think the ETF changes the picture, to your point, because it almost becomes self-fulfilling. If every dollar is being invested in the S&P, then those are the companies that are going to perform in line with the way the S&P is constructed. You could argue that that's going to be the best performer. But it also works on the way down. So if for whatever reason the environment changes and people are not as excited about stocks or want to take risk out, well, if all the money is in the S&P, then those are going to be the stocks that get sold the most. So I think that momentum can work both ways. And I think, we saw an environment in 2022 where interest rates went up and people reacted differently. Mm-hmm. But I do think there is a different type of investor out there, and I do think it's a change. So I don't expect us to go back to what we saw in the 2000s, but I also don't expect a complete continuation of the 1990s.
So with that in mind, I can make the assumption that from your point of view, and you correct me if I'm wrong, asset allocation is still appropriate.
I think so. I mean, we have the famous, we use a cartoon, which is the dodo bird, right? That literally has all its eggs in one basket. And we kind of show that in a lot of our materials and stuff. So I think asset allocation still makes sense. I think you have to adapt. And, clearly the U.S., has been dominating markets, and maybe that should continue. But I don't think investors should have their eggs all in one basket. I still, I can't imagine the environment where that would make sense, although it has made pretty good sense the last 5 to 10 years. But I don't see that continuing almost by definition.
So with that in mind, a lot of our clients at SmartPro Financial, they're listening to to more of the Ramsey personalities and that investment idea of be and grow stock, mutual funds or ETFs for the long term, and really look for four distinct categories of growth, growth and income, aggressive growth, and international.
Mm-hmm.
And the one that probably gives a lot of our clients, or we have the most conversations around, is international, as you can imagine, because if you look at what's out there and the driver of growth, international has been one that for quite some time, it seems like, why do I need to have that? Do I have this because of historical biases? Do I have this because it seems smart to have money outside of the United States? And there certainly are great companies out there, but you look at places like China and the EU, like, are those still viable markets internationally? And should our clients own international and emerging market mutual funds?
Yeah. It's funny because if you look back prior to 2007, right, look back prior to the financial crisis, international markets went through long periods of outperforming U.S. markets.
Mm-hmm.
But now we've had this, 18-year period now where that has almost not happened at all. And I think people are rightfully questioning whether that makes sense. I think there's a couple things we would point out. One is, even if you own the S&P 500, 40% of the revenues of the S&P come from outside the U.S.
Mm-hmm.
It's actually larger for the Mag 7. I think if you walked up to the average person on the street and said, what percentage of revenues do you think come from those 7 companies we all hear about all day long? I don't know what they would say. I don't think it would be 53%, which is the right answer. So it's hard to completely detach yourself from being exposed overseas. Now, some people would turn that argument around and say, well, that's all I need. I don't need international investing because I'm getting it through those companies. And I think there's some validity to that. I think the thing that I would remind people is really 2 things. One, there was a time and place over the last number of decades where the economic growth, the GDP growth, was actually much higher than the U.S. What shifted is, if you look at U.S. GDP, it's actually now higher than most every country. There's this period of kind of U.S. exceptionalism that's been in place over the last 15 years post the financial crisis.
Okay.
Whether or not that's definitely going to continue, I think, is debatable. The other one is the currency. The dollar's just been really strong, and we're doing dollar strong things, right?
Mm-hmm.
Tariffs are a dollar strong category. Having higher interest rates, it makes the dollar stronger, all else equal. So the dollar's been a real headwind for investing outside of the U.S. That's not always going to be the case. So we still approach it as they're really important. Samsung's an incredible company. Taiwan Semiconductor might be the most important company on the planet. It gets in the headlines because of the geopolitical aspect with China. Why wouldn't you want those companies just because they're domiciled somewhere else in your portfolio? I still think it makes sense, but obviously at some point it's going to need to outperform, or less and less of U.S. investors are going to believe they need it.
So places that most people think of international, they go, okay, I have developed markets in the EU or the European countries, and then China. Do you still feel like those 2 areas of the globe are viable? Specifically, maybe China.
Yeah, short. I mean, on the European Union, absolutely, because it's an incredibly important economic area. Obviously, it's had its challenges, and there's a lot of reasons you could go into, but it's an incredibly viable area. China is more challenging. China has real issues that and they're still claiming to have 5% GDP growth, and none of the other indicators that come out of China that aren't delivered by the government would suggest that they have 5% GDP growth. But there are some excellent companies that are located in China. The thing that's changed over the last 10 years relative to maybe what we experienced when China entered the World Trade Organization, which is when a lot of this kind of growth trajectory started, is those companies now have a ceiling that's different than it was 10 or 20 years ago. And what I mean by that is, because of how the challenges are in terms of nationalism or the technological issues, a Chinese technology, we've seen this with TikTok, it's just not going to be allowed to operate in very, very important markets like the US and Europe the way maybe it would if it was a US company or a European market.
Sure. So
to me, that puts a real lid on what China can ultimately be. And then you add in the fact that they've got real population issues. This is an economy, or sorry, a country whose population has already started to decline. That doesn't happen with developing countries as early as it's happening with China, and a lot of it goes back to the one-child policy. I think that's going to be looked back by historians as kind of one of the most controversial, if not one of the biggest mistakes ever done by a large government. And I think it's put them into a real problem. So we would be telling people, look at India, look at other emerging markets that don't have the issues that China has and don't have some of those challenges in terms of the ceiling. And yet those countries are still growing very fast and positioned well.
You see some of the estimations, in 2050, what the population of China might look like, and it's drastic. I mean, it's hundreds of millions less than what's there right now. And you kind of look at that and go, how, number one, if I'm listening to this, I might stop for a second and go, can someone explain to me why that matters? If there's less people, shouldn't there be less to take? Why does that matter exactly?
Yeah.
And maybe that kind of highlights some areas of the globe where you go, where there's growing population. If I look at places and countries in Africa or Southeast Asia that are growing rapidly, is there a problem with that as well? Is population growth this economic driver and decline that's just so evident, or can it kind of go both ways?
I think it does. I mean, I think population decline is the biggest issue, right? And Japan and China would be the poster children for what can happen to economies with substantial decline. And getting back to your question, why does that matter? Economic output is based on the number of people you have. I mean, there's a certain level of productivity that any person can have. So all else equal, if you had 100 million people and you're going to go to 75, there's going to be an incredible amount of productivity that would need to happen with the other 75 to make up for the 25 that are going away. And I would just bet that that's not going to be overcomable. And then also typically what's happening with populations that are declining is there's a real issue with the number of people in the workforce versus the number of people retired and ultimately dependent on those people in the workforce. So that's why it's so painful. And the other issue is once it starts, it's incredibly hard to stop. The bottom line is, China just doesn't have a lot of people in their child rearing ages because of what they did with one child. So it's not like you can just snap your fingers and change the policy and suddenly be solved. These are long-term issues that happen. So I think it's a real issue. I almost have, said that China is like not a country that one needs to worry about because they just have their own issue, which is going to be a huge one. To your point, rapid population growth the other direction without the infrastructure, without, kind of the things, education, the things in place that need to be there, can have the opposite impact. And I would argue, I think you almost can't have robust population growth without the things in place that are needed to take care of it. But I think that can be a challenge in certain countries like that. One of the reasons we like India is it just has incredibly good demographics. It's growing in terms of that population growth, but also the way that population growth is sorted, if you will, by decade is just very even. Even in the U.S., we have a little bit of population growth here, but we have an aging, society. But in India, they just have an incredibly positive demographic, kind of distribution, and that I think will bear fruit for the economic kind of journey that they're on.
So you mentioned the United States there for a moment, and do you feel that those population issues are not as prevalent here because of birth rate and immigration? Is that the idea?
It's got to come from somewhere. Our birth rate is pretty low, but it's not horrible. And then we do have immigration, and obviously we've had a lot of immigration in the past decades, and we may have less over the next decade. I think, but both those things can create the population growth that you need, or the labor force, or the workforce. The issue for China and Japan, just getting back to them, is they have no immigration. I'm going to get this stat wrong, but there was a year where the number of people that immigrated to Japan was like a double-digit number, like double-digit, like 15, not like 15,000, because it's an island. So obviously it doesn't have borders and like that. And then it's a society and culture that is fairly inward. I think it's not a place where you have a lot of immigration. I think to a lesser extent China is very similar. So there's not an obvious solution for those countries. You can argue immigration policy in the U.S. Certainly, we're doing that a lot today. But to the extent we have a population growth issue, there is a solution if one thought that that was a good solution and that you could have immigration from other countries.
So we talked about immigration, which is right now a hot button issue in the United States. And so I think this is a good time to transition for a moment into some of the policies that we're seeing right now with the Trump administration. And my question for you is, you're talking to fund managers. You probably have heard from people in circles in the government or CEOs of companies, and you kind of see what's going on and can read the tea leaves. What do you feel like people are excited about with the Trump administration's policies when it comes to business and investments? What do you think worries them?
Yeah. So I think one of the things that's really interesting, and I think the thing that Trump kind of ran on in this first administration and has followed through to this second administration, has been business confidence.
Mm-hmm.
Business confidence, whether it's small business or overall business, jumped by the most we pretty much ever saw back in November of 2016. And the same thing happened here in November of 2024. So businesses are excited about Trump policies in general. And it's just hard to deny that. You see the data and they like it. And so what do they like? I think they like some of the rhetoric because, Trump talks a lot about CEOs in business, and he talks about running the government like a CEO. But in particular, the tax aspect of it and the deregulation aspect of it. So if we think about tax, back in 2017, the corporate tax rate was 35%, and it dropped to 20%. And so just literally magically, all companies were worth more. If you had $1 of pre-tax earnings, they were 65 cents. Now they're suddenly 80 cents.
Mm-hmm.
So you got 20% growth just from the bill.
Mm-hmm.
So companies like that, investors like that. Deregulation is just less red tape to start your business and run your business. We've already seen like the Consumer Financial Protection Bureau, that getting rid of that. Again, you can argue there's good stuff they're doing. You can argue there's bad stuff they're doing. But the lack of red tape and the lower tax rate, businesses just like it. They like it because they can plan. They like it because they can hire. They like it because they can make investments. And I think it's pretty undeniable. The issue is going to be, and we've kind of focused on two real risks, is what could start to pierce that business confidence? What would make businesses feel less comfortable?
Mm-hmm.
Tariffs are generally one of those things. And the second one would be higher interest rates, and the two are related. So I think corporate CEOs would be less comfortable if they start to see tariffs, because tariffs are a tax and they go right at the heart of their profits, or they have to pass it along to their customers. So those are the things that I think would create a lot of agita within the business community, where that confidence that I'm going to go hire 10 people, I'm going to start a new factory, I'm going to start a new business. Well, if I'm dealing with a tariff or I'm dealing with, really high interest rates, those are the things that could keep me from doing it. So I think that's the yin and yang that the market's going to try to work through. Mm-hmm. In his first administration, we got the good before the bad, meaning you got a lot of tax and deregulation, and that really propelled markets in 2017 before we got the tariffs in 2018. This time it does feel like the tariff stuff is coming sooner. Mm-hmm. And I think that's going to be, just a little more of a puzzle for the market to kind of work through.
Can you explain very basically to our audience what a tariff is? Because some of us hear that term and you have an idea, but what exactly is that, and why would it be, or why would the Trump administration and his economic team feel like that's in America's best interest if it could be this destabilizing inflationary, issue?
Yeah. So a tariff is a tax. It's a tax on imports. And I think, the media, I think in general, has referred to it as being very inflationary. And I think that can be true in the short term. And the reason that is that a tariff is a tax on the individual or company bringing the good into that country.
Okay.
So they're responsible for paying it. But the argument that most economists would make is that they pass it along to their customers. So if I was charging $1 and it cost me 50 cents to produce it, now it's going to cost me 75 cents. I'm going to charge $1.25. We would argue over time that taxes are not inflationary. They're actually just bad for economic activity. So you're going to see less activity and less trade. And that is the concern that I think people have. But if we go back to kind of like, we were all in economics classes, or maybe some of us, weren't, but if you had to take an econ class, Econ 101, there's this basic idea. If you have country A and you have country B, and we can produce apples for $5 and bananas for 10, and they can produce bananas for $5 and apples for 10, it's better for us to focus on what we can produce for the cheapest and then trade with the other country that can also produce that low cost good. So if I'm trying to have 50% apples and 50% bananas, it's better for me if I actually trade with that other country than if I produce both the goods myself. Mm-hmm. The problem, and I think this is where, you say like, well, why would the Trump administration do this? There's really two problems that come up. One is I'm talking about apples and bananas, which are pretty straightforward. But if you say weapons and technology, things get a little more complicated, because do you want to be reliant on country B for your weapons? That's different than being reliant for them on bananas. So I think that's one aspect. The second aspect is that if I had an industry in place where I had a bunch of apple pickers and I had all those constituents, and then suddenly country B comes along and they can produce apples cheaper, well, if I start outsourcing all of that trade to them, then I've got my apple pickers in a bad place in the US.
Yeah.
So the reason that I think countries use tariffs is either to protect industry or to protect that kind of technology and national security. So, I think in a perfect world, you would just not have any barriers in any way, and you could have global free trade and the whole Econ 101 thing would work. The fact is the world's more complicated than that. And then the other, I think argument that that President Trump makes, or maybe some in his administration make, is, well, everyone's doing it to us. We don't have, our tariffs are lower than China. So why should we allow Chinese goods to come into our country when they charge us a tariff? So I think it's a really complicated argument. I think sometimes the media boils it down too easily and just says it's bad and it's a bad policy. And most economists do agree with that. But the reality is there's a lot more complexity to it. But I think in general, if you see higher tariffs, that's going to be an impediment to trade. And in general, that is not good for economic activity. And I think that would be the concern that we would have about that escalating.
Do you feel, so it seems like in some of them, more recently, the tariff threat, or even them going through, is almost a punitive penalty against countries for maybe doing something that we feel like is inappropriate. The one that comes to mind is a 10% tariff on China for fentanyl. That's different than just having a tariff, to tax a product, right? That's using it as a political tool, mm-hmm. in a way that's not necessarily just to drive up, more tax revenue for the United States. Is that something that's typical, or is this very just Trump, policy?
I think it's atypical. I think the question is it a negotiating strategy to get people or countries to the table to achieve strategic gains? And a lot of people in the president's circle argue that. And I think there's some evidence to support it, right? Our tariffs went up a little bit during the first administration, but when you really look at what mostly was done, it was China. There wasn't a lot else. So I think there is an argument that it's a tool to get people to the table to achieve some sort of other benefit. But I do think that at some point someone's going to blink, and we're going to have to implement, and that could be painful for consumers. And it was a little bit interesting as the Canada and Mexico tariffs were getting closer. It was the first time that the president admitted that there might be some pain for U.S. consumers. And it's not necessarily clear, especially in the case of like a Canada, like what are we trying to accomplish? Like what is the major issue here between the two countries? There's not really a border security issue nearly as much. Most of what they import is energy-related items. So it's interesting. That said, Canada and Mexico have a lot more to lose than we do. We are 70 to 80% of their exports, mm-hmm. And exports are a major part of their economy. So we are in a position of strength to do these negotiations. But I am curious to see what we're ultimately trying to accomplish. It's not as clear to me as it would be with China.
So something else right now that seems to be very much in the news cycle, I mean, no matter what you watch or consume, it's this Department of Government Efficiency, right? This idea of, hey, there's waste? How do we get rid of it? How do we identify it? And so we're seeing that in a massive scale. It seems like almost by the hour, there's something that's popping up. How much do you feel like do you feel like, number one, that's going to be helpful long term, and how much do you feel like this is kind of a prelude to something that could be an issue in the future, which is just the U.S. debt?
Right. I think, it's interesting if you do polling on people's perspective of government spending, and even if you add in kind of the Doge, which gets a little political because obviously Elon Musk is involved and it gets into kind of an approval rating of him. If you kind of look at those numbers, like broad support for, smaller government and trying to work through wasteful spending and things like that. I mean, I think it's in like the 70 to 80% range, which is hard to find a lot of things that you can get 70 or 80% to say, yeah, that's a good idea.
Right.
So, and I think it also would be hard to argue that there aren't things you could obviously cut within government spending, given where we are. I mean, we haven't balanced the budget in over 25 years. I mean, it was 2000 was the last year we did it, or 99. So I think it's a very ripe case. Now, the way you go about it is obviously where I think people are taking some issues with the current administration, but I think most people agree with the end goal. Most people.
Yeah.
So that can be a positive for U.S. interest rates. The challenge that we have in the U.S. is we have all this debt outstanding. We have not balanced the budget in 25 years. We are the reserve currency, but we have a bunch of debt that needs to mature regularly. The average maturity on the debt right now is about 2 to 3 years. And so that means that, over the next 3 years, we're going to, I think it's something like 50% of our debt, which is a lot of money, is going to come due. Now that debt was old, so it was at a lower interest rate. Now we're going to be refinancing at the current market rates, which are anywhere from 150 to 300 basis points higher. So left without doing anything, our cost of capital in the United States is going up, and that debt and that deficit is going to get worse. So I think it's really good to try to get ahead of that and send the market a signal that we're serious about trying to get the deficit down. But ultimately, you're going to have to see actual improvement in deficits, or even, God forbid, balance the budget, and then you could see, a real difference in the market. I'm not of the view that this is going to get away from us, because I think as the reserve currency, you've got a lot of protections, and we're still kind of the best house in a bad neighborhood, because all of these countries have this same issue. But I think being proactive and trying to get ahead of it is actually a real positive.
Yeah. So kind of narrowing focus back down, we had talked about these big things, going back down to what investors may be thinking about is, where do I put my money? In our world, it's, how do I invest my IRA, or how do I make sure that I'm allocated properly? And in the retail investment side, people, a lot of advisors are actually going in and picking out funds and ETFs and kind of doing their own level of research, or I don't even know if you can call it necessarily due diligence, but maybe they call it that, but they're kind of going through this process of trying to find out, what do I think's best? What do you specifically, as a professional that has the pedigree and the background, the skill set, and a research team to be able to do this, what do you look for in fund managers? And what do you think the do-it-yourself, maybe not investor, but the do-it-yourself investment advisor or financial professional misses?
Yeah. So in terms of what we look for, I mean, our starting point is always looking at an organization and the quality of that organization and how it's structured. I think that's not where a lot of people start. But my starting point is, I want to make sure that I'm investing with an organization that I believe in, and that I believe is going to be consistent over time. So what I mean by that is, is there broad ownership of the employees? Is there a succession plan in place? Am I investing with, a patriarch or matriarch who, has a long investment time horizon in front of them, rather than I'm dealing with a retirement or a succession in the first couple of years of my investment? So I really want to see these stable organizations, and I think that's hard, right? It's hard for an organization to have success and create that stability. But if you can find that, I think that's really important. The second thing we're looking for is we're really going to ask ourselves what investor, when we look at this advisor or manager, what advantage do they have? What is that advantage? Are they looking at a particular niche that maybe other people aren't looking at? Do they have something about their background or experience that makes them better? I mean, the easy example is like a venture capital firm that has backed all these wonderful, VC companies. Well, now they've got this track record. And so it almost becomes self-fulfilling when the next great startup comes along. They want to work with so-and-so because they have so that's a huge competitive advantage that one organization would have relative to another. It's not as relevant to picking a large cap mutual fund, but I really want to ask myself, like, what is the benefit? Is it company access? Is it management access? Is it the level of research? Is it the amount of research? If you're talking about a more niche market, in emerging markets, is there some, incredible advantage they have there by being located in those markets or spending time there? So that's really the second thing. And then the third thing that we would look at is I'm looking for consistency in a lot of small victories. I think so much of where the assets end up, and this will get to the second part of your question about what do people get wrong. So often it's the big wins. Somebody went to cash in 2008, or, they shorted mortgages, the big short, you shorted mortgages. You got this one huge thing right. The technology bubble in 2020, 2021, people were riding that. They got the Zoom and all these things correct. They have this massive outperformance. Huge victories are not as repeatable. It is so much less likely that that's the sort of thing that's going to happen over and over again. Yet those are the types of stories that attract all the capital from investors. So I think, when we think about, we're actually looking for people who just added value more consistently over year after year after year. And it's not that they got one decision right. It's that they got 20 out of 30 decisions right. And really when they got the 10 wrong, what did they do and how did they protect our clients' capital in those periods? So to me, an organization that I can be confident in the stability, I can identify an advantage they have relative to the market, and then I've got a track record that shows that stability and consistency, that's the type of organization that we're looking at. When you think about, what mistakes, I think, whether it's advisors or investors, I think there's just a lack of understanding of how performance is created. I look at performance, right? I'm not saying you shouldn't look at performance, but I think it's critical to go under the hood and say, well, how did they do it? And is that something that I believe is repeatable? So I'll give you an example. There was a manager in the emerging markets that has outperformed, and they're a very popular manager. But one of the reasons, or really, in my opinion, the reason they outperformed is because they were investing outside of emerging markets. They had a lot of stocks that were in developed markets. Well, it just so happened that developed markets had done better than emerging markets. But you don't invest in emerging markets because you want developed markets to do better. Yeah. So when emerging markets actually did outperform, they tended to not do as well. But I think because the overall track record was so much better, that's just where people gravitated because they weren't understanding the how. So sure. I think that's something that people miss all the time. And again, it's not easy. This is why, it's hard, but you have to go in and really understand why. The other thing I would say is I think investors really struggle to understand how asset growth really impacts returns. And we all struggle with this, right? Because if you have success, you're going to attract assets, especially in this day and age. There's firms managing $100 billion in Santa Fe, New Mexico. All due respect, it's a beautiful place. But you don't have to be in a money center to attract capital these days. But when you attract that kind of capital, it creates issues. It's either going to lead to owning more of the investments that you have, which may create liquidity issues, or it's going to force you into a different universe than what you did to build your track record. So to me, those are the really important things that people miss. And we kind of see it over and over again in how, in my opinion, investors kind of misjudge the impact of those two things.
So then what you're saying with that last example is you can almost be too successful in attracting capital. Maybe you have one of those big years or 2 years that's very difficult to repeat, and that's where money tends to flow. And you're not going to be able to get those, potentially that's going to be very difficult to repeat those returns or that style because it's more of a one hit, event.
Yeah, I mean, if you're managing $1 billion and you make 20 investments, right? I mean, it's $50 million an investment. You can invest in a lot of companies with $50 million. But if you're managing 100 billion and you kind of do the math on that, and then how many companies can you actually put, that $5 billion into instead of that, that 50 million, the answer is not many.
Mm-hmm.
So it's as easy as kind of looking at it that way. And then I think the other part of it is, I think managers have a hard time closing. They have a hard time turning off the spigot when things are going good.
Yeah.
And then that creates those problems. And now we have ETFs, right? And we talked a little earlier about how ETFs exist now, and that's kind of changed the market environment.
Right.
We're starting to see active ETFs.
Yeah.
You can't really close an ETF. So if you're an active manager, you can't really close. It's not really the same as a mutual fund. An ETF kind of has to be open and trade. So this is a question we've asked ourselves. Is it possible to manage capacity properly with an ETF? If you're following an index, it's not a big issue. But if you're an active manager, the answer is it's really hard. And I think it's something to think about, if we do see these active ETFs become really popular. There's not really a mechanism for them to manage their capacity properly.
Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and SmartPro Financial are not affiliated.
So let's jump into this idea for a minute, because I feel like in the investment world, this is like a hot topic. This is like the insurance world's version of whole life versus term insurance. It's like active versus passive, right? And like people get super into it. And it seems like it's this binary thing. It's one or the other. And there's no in between. They don't mix in portfolios. And I don't know about that. What's your opinion of that idea?
Yeah. So we do think they mix, right? We do think there's a role for both. I think the term passive is one of the greatest marketing, maybe other than Kleenex and I'm trying to think of the other ones, Coca-Cola. I mean, it's one of the greatest marketing kind of brands out there, because there's nothing passive about indexing. It's actually you're just going to own more of your winners and less of your losers over time. That's actually a momentum strategy, which is the way it's constructed. So I think you have to separate the S&P 500 from everything else. The S&P 500, and we all see the data, it outperforms, anywhere from 2/3 to 3/4 to 80% of active managers over time, if the data is kind of constructed properly. But a lot of that has been driven over the last decade, where the largest contributors to performance are coming from the largest companies. If I started an asset management firm tomorrow and I was trying to beat the S&P 500, and I really thought Microsoft was an awesome company, it's just, I think it's going to outperform. I think it's great. I might put 5% of my capital in it. It's a big position. Mm-hmm. Well, guess what? I have a 2% underweight to the S&P 500.
Yeah.
I could be right and I look like a total idiot. So I would have to put 10% to have a meaningful active weight relative to the S&P. And I think that's the conundrum that concentration has taken for active management. That sort of concentration doesn't really exist in other indices. If you're talking about international or emerging markets or small cap or even fixed income ETFs. So I think there's a lot of active management that you can do in those other areas while still indexing the S&P. But the one thing I would just remind everybody is Microsoft could announce tomorrow that they're moving to a 52-week-a-year vacation policy. Yeah. Just make up your crazy headline. The S&P 500 under the S&P 500 index is going to do nothing different. The only way a position goes down in that index is that it could get acquired. It could get, really it just gets acquired. It's just performance. The only way it can go down is it does less well than all the other stocks. Yeah. And usually that means the stock price is going down. So I think that's a real risk management issue. But we've been in a period where the largest companies are delivering the most earnings and investors have the most appetite for it. But I do think that can change. If we go back to 2000, only one of the companies that's in the top 10 of the S&P 500 was in the top 10 back then, Microsoft, using my example. Mm-hmm. So when we fast forward 10 years and look at it by each decade, generally only about 4 of the S&P 500 top 10 names are still there. And the only way that happens is performance.
Yeah.
So it's an incredible index. A lot of money is attracted to it. As we said, if it almost becomes self-fulfilling because so much money is being indexed to it, I think there's a role for it in portfolios. But I think there's a role for also doing some things differently to help manage risk and do asset allocation like we talked about earlier.
So it's interesting because in this idea, this is one that, again, you go back to what people may be consuming, whether that's the business news or, the internet, YouTube, whatever it is, where they're looking for financial, wisdom. Probably not going to find a lot of it in those places, but if you're going there to look for it, you're going to get this idea that no, you just need to be all in, passive, or active. Or active is it's gone. It's not important. It's irrelevant. And with how Summit Trail and your team views this, you're like, no, there's a place for both.
Right.
And I think that's an interesting idea for a lot of people that maybe don't really understand that. They think it's all in on one side or the other.
Yeah, it doesn't have to be. And I think this has been good for the asset management industry, right? There was probably a lot of complacency in the 90s and 2000s, and there were probably too many fees going to the asset management industry. So the performance of the S&P has forced managers to adapt. We've got to either be more competitive on price, we've got to deliver better performance, we've got to be more tax efficient because the S&P 500 ETFs are really tax efficient. So there's been a lot of what I would call kind of positive innovation, including ETFs, that I think have made investors' lives better. And I think a lot of that is being forced by how strong the market is for the S&P. I would just remind people how it can change, and I think a decade like the 2000s really proved that. And if it just isn't the case that these large companies are driving performance, and again, my view of the world is that kind of success really only invites two things: competition and regulation. Yeah. And those are hard things to survive, which is why you see companies turn over even though they're really successful. If that happens, that's going to be a very different environment for how the S&P 500 performs relative to everything else. And I just think investors are well served to remember that.
So on topic, but a little bit more nuanced, do you feel like when you're seeing maybe not these best managers that you guys are bringing in, but maybe when you're doing research, you're seeing other firms, they're going, okay, we feel like we're competing against this behemoth in the S&P. And we have to do two things. We either have to try to outperform it, which has been increasingly difficult. And the way to do it maybe is concentration, which is adding risk. Or do you feel like firms that are really good are going, okay, we're going deeper in our research, we're finding gems that maybe we hadn't looked for before, areas? Or do you go, we're not even playing that game? Like, that's not the game we're going against right now. How do you think that lays out?
I think advisors are adapting in a couple ways, to your point. I mean, one way they're adapting is I think they're trying to improve kind of their non-investment services, right? A lot of groups are, tax planning, financial planning, what I'd call kind of the family office services. So you're seeing a lot of it like, yeah, let's just index. We get it. Can't beat the S&P 500, but we're going to do all these other things for you that are really important. And so you see that. I think the other thing you're seeing is advisors kind of saying, yeah, let's kind of compartmentalize. Here's your S&P 500. That makes total sense. But we can add value in bonds, or we can add value in small cap or private equity, or asset classes that are harder to access. So I think it's generally one of those two things that advisors are trying. And I don't think there's anything wrong with that. I think that's not an unreasonable way to do it. I just think that if you kind of totally give up on the investment side, you're assuming that the last 10 years are going to be exactly the same going forward, and markets have just shown us over and over again that's not the way it goes.
So I got a couple more rapid fire questions to throw at you before we kind of come to an end on our conversation here. But
great.
One of them, we hear a lot is, AI. What does that look like? Does that excite you? Is that something to be feared? Is that a position that's going to continue to give momentum to the market?
I think it will. I mean, so from my perspective, it's exciting. It's terrifying, because we grew up on War Games, which was a Matthew Broderick movie in the 1980s, and That was kind of our first experience with AI. Um, but I think we're all seeing it in our day-to-day lives. Like it's changing and it's starting to happen, and you're talking to these machines and you don't even know it. So I think the thing from a market perspective is it's created this capital expenditure cycle that's almost somewhat self-fulfilling. And what I mean by that is companies are putting so much into exploring how they can use it that NVIDIA's top 6 customers are the other Mag 7 stocks that are all spending so much on AI. So it's this self-fulfilling loop of like, we're going to put $20 billion into this thing. Well, that's going to drive earnings just throughout the economy. So I think that's a very powerful thing. The question is going to be, are you going to get a return on that investment? And I tend to be a little more skeptical that that's necessarily going to be true. I don't think AI is not going to be a thing, but the question is, how is it going to monetize itself? And we saw a lot of this back in the internet. The internet, we saw this CapEx cycle in the late 90s, but unfortunately, a lot of that capital did not get a good return. Pets.com and these things that are kind of famous poster children of that era. So the question is, are we going to get a good return on our investment? I think there's a much more promising outlook for that, but it is still a question of whether that's going to continue to propel the economy, and how do you actually make money off of it going forward as a company.
Crypto, I'm sure you get that one, and we do too. And it's not necessarily asking your particular, advice on any of that whatsoever. It's more so just, this is this disruptive idea that's here. Is it one that's here to stay? I mean, now it's getting political, right? Where there's talks of that with, the government, the Treasury, and the Fed. Like, is that a real thing? Because It used to feel like it wasn't, and now it kind of feels like it might.
I think it's a real thing for the asset management industry. I think the question is, and going back to what we were just talking about with AI, so most of us started to hear about it in kind of 2017, 2018, and it was blockchain, and then it was Bitcoin and crypto. And obviously we went through this evolution. At the time, it was kind of viewed as a medium of exchange, right? That was kind of its initial, it's like a currency replacement. Well, that's not what it's become, right? I don't think many of us are doing anything differently than we were 6 years ago in terms of how we pay for things and things like that. Then it was kind of positioned as a storer of value. It's this digital gold. Again, like inflation was the highest it's ever been in 2022, and it got clobbered, right? So I don't know that it's fulfilled that economic kind of case that was ultimately created.
Sure.
However, it's become this asset management tool, and it's a tool for people to speculate. I would argue it may not be the best tool to speculate, because I'd rather bet on a company that can have some sort of wild outcome rather than, really what you're betting on is adoption or other people coming in, which has been a good bet so far. So I think it's a really interesting kind of asset management tool. Obviously, there's a lot more to it. There's stable coins. There's, things that might ultimately have some value. But I would still kind of point out that it hasn't really been very disruptive to the economy. If it went away tomorrow, you'd probably have some pretty upset people, but it wouldn't really change the way we do things.
Interesting.
So to me, it's really a financial asset, and I think it has been disrupted in the financial community, but I don't know that it's an economic asset, and I don't know that it has economic value, which is why I would put it differently than something like AI, which I think has been disruptive, clearly could have some economic value, but obviously you got to deliver on that promise.
Do you feel like gold makes sense in people's portfolios?
I think in general it does. I think where, again, you can argue this either way, but in general, I would say we are running large structural deficits as a country. You have a currency that's very strong right now. Despite that, you could see an environment where the currency could weaken, and you could see an environment where inflation is higher. And gold generally does well in each of those environments, and I think that's one of the reasons we've seen it do well, over the past kind of 5-6 years. So I think for us, like, to me, that is a true inflation hedge. That is a true asset that has a storage of value, and I think, obviously it depends on the client and percentage, but we think it makes some sense.
So you've had and are having a fantastic career, and I don't know if the right term is on Wall Street, but that's what, people hear, right? What have you seen that's changed from the first time that you're interacting in that environment to now? Was there fundamental changes that have occurred in that world?
I think the information change is just kind of staggering, right? The way, I think about information and the way we got information in the late 90s and even the early 00s, and the amount of information I had at my fingertips then versus now. I think we've seen that with markets, right? Some of the cycles have shortened. Market cycles used to be 3 and 5 and 7 years long, and now they're 14 months. So to me, that's the big difference in kind of the last 25 years, is just how quickly information goes around and what that means for markets and prices. You could argue that makes the market even more efficient than it was, and I think that's fair. And again, I think that's an argument for the role that like an S&P 500 plays. But it's really true about that subset of companies or that subset of information that's so focused on the same thing. And I still think there's a lot of things out there, whether it's an emerging market or a small company, where you could argue that, there's still these information, kind of differences in what's out there. But the information speed and the, how quickly it's transmitted and how quickly it's priced in is probably the biggest change, I would say.
So the closing question that I want you to spend a minute on or so, your time in the industry, if you're talking to, an investor at any stage in their investment, life cycle, maybe they're just getting going and they're listening to this for the first time, going, oh man, I want to start investing.
Yeah.
To somebody that's been in the market and had experience and done this for quite some time, what's one piece of wisdom that you feel like everyone should have to build long-term wealth?
Yeah. I think my big thing, and where I've seen this be successful, is you have to have a plan. You have to have a plan. It doesn't, there are different plans that work for different people, but I think the absence of a plan is what can really create the problem. And what I mean by a plan is to say, okay, I'm starting my career. I'm going to put $100 away every month or whatever it is, and I'm going to put that into the S&P 500, or I'm going to buy a couple of mutual funds, or even if you want to buy a couple stocks, but I'm going to do that repeatedly, and I'm not really going to deviate. Obviously information can change, and as you get older, maybe you take a different approach, but I think having that plan provides you such structure, and it allows you to stick to something when it gets really hard to continue.
That's right.
The people who have had the most success, in my opinion, are the ones who stick to the plan, and just continue throughout. Whereas I think the absence of a plan creates the challenge of when new information comes in, it may change what you do. And I think the folks who have had, like when I see a client who's not done well, or if I see a situation that's not a good financial outcome, more often than not, it was because they kind of changed course at the wrong time, right? I sold everything in March of 2009 or April of 2020. It's rare that you sell everything in January of 2020, right? So it's that change in course that really whipsaws people.
Yeah.
And I think when you've got it laid out, here's my strategy, here's what I'm going to do, it just provides such an effective backdrop for one to execute, and then you stay the course. And that to me has been successful.
I 100% agree with that. I think that there can be complex plans, there can be simple plans. The idea is stay on the plan, stay on course. And and with our clients and in the Ramsey world, it's he always mentions the ones that jump off the roller coaster are the ones that are going to get hurt.
Yeah.
Don't get off, keep going. And we consistently see, it sounds silly, but we consistently see that an investor that hasn't necessarily paid attention, not that they haven't paid attention in adding and being diligent about investing systematically long-term and sticking with it, but the ones that maybe accidentally go, I haven't looked at my 401k in 10 years, but they've always put money aside and it's been invested well, tend to be the best clients, because they're looking at it long-term, and they're not looking at, what's happening in the news cycle or what's happening in, in the accounts or checking the statements all the time. Because even for me, somebody who's a financial professional, I get, pent up and anxiety when I do that.
Yeah.
Seeing the ups and downs. And so it's the ones that are almost like blinders on. I have a plan, I'm going to stick with it, and I'm tethered to something that allows me to to stay in and not make maneuvers. I think that's incredibly good.
I think that's right. The 401k, the 529 plan, I mean, often those are the things that do the best. And the reason is because you've kind of got a limited menu of options and you've got that repeatability of doing it every time. So I think the idea is to take those lessons and apply that. You can create your own 401k. Unfortunately, it's not going to get the tax deduction that you get in a real one. But why not create a program like that in your real life where you take, a portion of your paycheck every 2 weeks and put it aside? The discipline there is incredibly powerful. And if you look at the compounding, effect that has of just every time and doing it and what that means over 20, 30, 50 years, it's incredibly powerful for wealth generation.
David, thank you so much for your time. Thank you for the wisdom you shared. I know that it's going to be highly beneficial to anyone who listens to this. So thank you for spending this hour talking to us. This has been fantastic.
Absolutely. Enjoy it, Rick. Anytime.
All right. Thank you.
All right.
Hey, thank you so much for joining us on this episode of SmartPro Radio. If you enjoyed this episode, make sure to go to our website at smartprofinancial.com. We're going to find more episodes just like this one under our news and research page. And make sure to tune in on April 7th, where I'll be hosting business coach and former NFL player Sam Rogers. See you then.